Good morning and welcome to Before the Bell with Roman Zane. It's Friday, August 29th, 2025. And as we close out the trading week, we're not just looking at numbers, we're trying to make sense of a day that is both a look back and a look forward. Today marks the 20th anniversary of one of the nation's worst national disasters, while at the same time bringing a crucial read on the health of the economy with a key inflation report. Zane, it's a day of significant headlines.
It certainly is, Roman. It certainly is. The market is digesting a complex mix of signals. We saw solid performance in the broader indexes yesterday, but the caution that has defined this week remains. Today's release of the Personal Consumption Expenditures Index, the Fed's preferred measure of inflation, is the main event. It will either confirm the Fed's path toward rate cuts or throw a wrench into the works.
Exactly, Zane. And layered on top of that is a geopolitical battle that is directly affecting global trade and a constitutional showdown that could redefine the independence of the Federal Reserve itself. These are not isolated events, once again. They are threads in the larger tapestry of a rapidly changing economic and political landscape.
All right, so moving on to our market rundown, let's start with a quick snapshot of where we landed on Wall Street. Yesterday was a day of mixed signals that ultimately closed on a high note. The
Fair.
S&P 500 closed at a new record high, gaining about 0.24% to a new stock price of $6,501.86, while the tech-heavy Nasdaq was up slightly, showing a divergence in confidence across sectors. This morning, futures are pointing to a cautious opening, with both S&P and Nasdaq futures down modestly as traders digest today's inflation data.
For our bell ringer today, Zane, we're not just focused on a single earnings report, but on a macro data point that is setting the tone for the entire market today. The latest US GDP revision, that is. The Bureau of the Economic Analysis just released its second estimate for the second quarter GDP, and it's a powerful signal that the US economy may be more resilient than may feared.
Certainly is. That's very interesting, Roman. The initial GDP estimate was already solid, but the revised data shows the U.S. economy grew at a faster 3.3% annualized rate in the second quarter. That's a significant upward revision from the previous estimate. This is not just a statistical footnote, it's a market moving headline because it's a direct response to a key question investors have been grappling with for months. And that question is the economy headed for a hard landing?
Exactly, Zane. This data is a direct counter narrative to a lot of recent cautious sentiments. It provides a strong fundamental case for long-term bullish story. The detail that's most compelling is what's driving this growth: consumer spending and, most importantly, investment in artificial intelligence. This shows a powerful convergence of a strong consumer demand and a continued high conviction spending on our very own technology that's been fueling this market's rally. It's a powerful validation of AI investment thesis.
And the implications of it are very immediate, Roman. This new data gives the Federal Reserve more breathing room. With the economy showing such underlying strength, the Fed is not as under much pressure to rush into rate cuts. This might lead to a more wait and see type of approach, which could cause some short term volatility, but it provides a more stable foundation for the economy as a whole. It's a bell ringer because it fundamentally changes the conversation from are we headed for a recession to how strong is this economy really?
Thank you, Zane. And now let's move on to the inflation report and a landmark anniversary, as today is August 29th, 2025. This is a day of two very different but equally important headlines. First, the economic world, we've just seen the release of the PCE report. The PCE report is the Federal Reserve's preferred measure of inflation, and all eyes were on it as the Fed was expected to trim down its benchmark interest rate at the next meeting. The latest data showcases that the core PCE, which excludes volatile food and energy prices, ticketed up to a 2.9% year to year increase, the biggest increase since February. This puts the Fed in a difficult position as it's caught between the goal of taming inflation and the pressure to support a slowing economy.
At the same time, the nation is marking a somber but significant anniversary. Today is the 20th anniversary of Hurricane Katrina's landfall on the Gulf Coast. Commemorations are taking place in New Orleans and beyond, with the focus on both remembrance and resilience. Events like the annual Katrina March and Second Line are being held to honor the victims, but also to bring attention to ongoing issues of infrastructure, climate change, and racial inequality that the storm so starkly exposed. It's a powerful reminder of how far the city has come and how much work remains.
That's a good point, Zane. The anniversary of Hurricane Katrina is more than just a historical event. It's a powerful lens through which we can see the interplay of economic vulnerability through racial events and the disaster response that took place. When we look at the data from the storm, it's clear as day that the impact was not felt equally.
Absolutely, Roman. The storm's devastation was a national tragedy, but the long term effects were and continue to be disproportionately felt by different communities. For example, of the 971 Louisiana residents who died as a result of the storm, rest in peace, 51% were black and 42% were white. In Orleans Parish specifically, the mortality rate for black residents aged 18 and over were 1.7 to 4 times higher than for white residents in the same age group.
And the economic fallout tells a similar story. Many of the city's black and low income residents were already living in less elevated areas, which were more vulnerable to flooding. A disproportionate number of African American residents lived in areas that experienced more severe flooding, as many as three-quarters of black residents compared to about half of white residents.
The displacement and recovery were also divided along racial lines. Before Katrina, New Orleans' population was around 484,000, and it fell to an estimated 230,000 after the storm. While the city's population has since grown, it has not returned to pre Katrina levels, and the demographic shifts have been significant. New Orleans' population remains majority black, but tens of thousands of black residents were unable to return to the city.
Yeah, and this isn't just about what happened 20 years ago. It's about those real life events that reveal the truth of our current systems. The conversation today about the PCE reports, the Fed's actions, and the health of our economy is happening against a backdrop of deeply rooted inequalities. The anniversary of Katrina reminds us that we track and analyze financial data. These are real human and real life costs that can be aggravated by both natural and man made systems. That is a powerful and somber thought to end the week on. It puts our day's financial headlines into a much broader and perhaps a more important context. But before we go on, there's one more significant headline we need to touch on. It's a geopolitical battle that's been directly affecting global trade, and it's coming in an unexpected direction.
That's right, Roman. We're seeing a new wave of protectionism. The U.S. has enacted a sweeping escalation of trade tariffs, sending shockwaves through international markets. These tariffs aren't just targeted at one country, but are a broader measure affecting a wide range of goods and nations. This is driven by a complex web of economic and political rationales.
Exactly, Zane. This isn't just about a trade spat. It's a fundamental redrawing of a global trade map. The move establishes the highest average U.S. tariff rate since 1933, and according to analysis from the Yale Budget Lab, it's projected to cost a U.S. household the equivalent of $2,400 annually. This immediately disrupts established supply chains, inflates corporate or operating costs, and casts a long shadow over investor sentiment worldwide.
$2,400 annually for the average U.S. household is a lot. A lot of these people are living paycheck to paycheck, so it's going to be crazy to see how this works out. And these implications are immediate and far-reaching. We've seen a shift in global trade dynamics as companies rush to front load imports to beat the tariffs, a trend that paradoxically boosted second quarter GDP, as imports are a subtraction from the calculation. But this is a temporary effect. In the long term, these tariffs could harm the economy by raising costs and making U.S. firms less competitive. It's a bell ringer because it introduces a massive variable into the global economic equation. This makes long term planning incredibly difficult for multinational corporations. This is a clear signal that the world is moving toward a more fragmented and unpredictable trade environment.
Yeah, Zane, this is the new reality of elevated tariffs and the geopolitical uncertainty that is going on. This is a huge headwind for global growth and and a source of short-term volatility. The market is trying to price a world where the trade is no longer a given, and that's a difficult calculation.
Yeah, it's been a heavy week, Roman. It's been a lot to unpack, a lot of news going on. Nobody really knows what's going to happen next. But I guess for now, we're going to have to just wait and see. Labor Day, we're off. Um, Tuesday, we're back on. So we're going to see how the market digests this latest data. Until then, stay safe and thank you for tuning into Before the Bell. And of course, as always, nothing here is financial advice. We are students sharing our learning process. That's all the time we have for Before the Bell. Thank you for joining us.
And we'll see you guys on Tuesday.